Good morning and good afternoon. I believe I know most of the people in the room here today, but for those who do not know me, my name is Graham Shuttleworth. I'm the CFO for the group, having assumed that position in 2019 at the time of the merger with Randgold. In that context, I've spoken to many of you before, and specifically at this Investor Day 2 years ago. So in part, my presentation is a continuation of some of the themes we have previously touched on, as well as some new insights. I'll start my presentation today on a review of our supply chain initiatives before moving into some more of the key financial aspects. This is a quick snapshot of our supply chain activities across the globe. The supply chain team, which is headed by Rian Krobler, manages some $8.5 billion of annual spend across 5 continents with over 8,000 suppliers. Having said that, it's not a large team, with our philosophy being one where day-to-day operating responsibility is devolved to each operating mine, with a small but highly effective central supply team providing oversight, coordination, and strategic direction. Through a combination of on-the-ground knowledge and collaborative demand planning, utilizing the investments we have made in our global systems, notably SAP, and working together with tried and tested supply partners in each region, the team is able to align on standards, minimize investments, leverage the buying power of the group, and deliver meaningful results, as I will show you in the next few slides. This team is also integrally involved in our new projects, and over the last year has been working closely with our Reko Diq and Luana project teams to ensure we deliver on schedule and on budget. I wanted to share with you a snapshot of the underlying price trends in some of the key input parameters. This is obviously by no means exhaustive, but illustrative of the point that whilst we experienced significant inflationary pressure over 22 and 23 on the back of COVID and Ukraine crisis, in a lot of cases, these prices have come back down to 2021 levels. That is not to say that our suppliers brought their prices down, but rather our team had to work hard to realize these savings through a combination of renegotiations, supplier rotation, leveraging our buying power, while strengthening our relationships with our key long-term supply partners. Some areas still remain elevated, particularly in North America, with cyanide, cement, and lime, but we continue to engage and are working to get these down in the future. With respect to diesel, for the purposes of our budgeting, we are assuming a slight increase in 2025, and that reflects our assumption on the oil price, which we have increased to $80 a barrel WTI from $70 last year. So given where spot prices are currently, there could be some benefits in the year ahead. At the time of the merger, we set ourselves a target to reduce the amount of working capital locked up in inventory at our mines. Managing mine site inventory requires the participation of the whole team to ensure a balance between enough stock to ensure the mine keeps operating, but not hoarding more stock than is necessary. As you can see from this slide, we have reduced this amount by over 20%, whilst at the same time increasing the cover we have in place on the key gold stopper items to ensure up to 5 months of consumption on site from our previous 1-month target, as well as supporting the PV expansion construction project and startup. This is even more impressive when you consider that US dollar inflation is up over 25% over this period. Our aim is to maintain this discipline going forward. Some of you will recall the savings targets we set ourselves at the time of the merger, and since then we have been consistently setting and achieving new targets. Every year, the team identify new opportunities for savings and set objectives to push themselves to ensure we minimize our cost base and do not lose sight of even the smallest opportunities. It's a constant process, But given the savings achieved are annual, the continual value add to the business is significant. This year, initiatives are underway at NGM between the technical, financial, and commercial teams to drive efficiencies, specifically on equipment lifecycle management, as well as focusing on process control technology to crystallize efficiency gains in our business and drive down costs going forward. Our supply chain strategy is not just about what we buy. It also considers our broader sustainability objectives, one of which is ensuring our operations benefit the countries and communities within which we operate, and to expand our local footprint. This means that we actively set targets for local supplier procurement, which in a lot of cases means developing local suppliers and helping them grow into businesses that can compete on an international scale. These numbers reflect just direct supplies and do not include the benefits of salaries, taxes, and other payments we make in country. The local procurement strategy has the added benefit of increasing our alignment with our stakeholders and is a key part of managing risk in the countries we operate in. Scope 3 emissions are the indirect greenhouse gas emissions that occur in Barrick's supply chain. We have identified Category 1, purchased goods and services, as the most material and impactful Scope 3 emissions category to address. Our Scope 3 reduction roadmap categorizes our suppliers. We then prioritize and engage with priority suppliers where we have determined that reductions are possible. We will assist these suppliers to determine their own emissions profile and quantify their GHG footprint, then work with them to identify and achieve reduction targets. Turning to our financials, here we highlight what we have achieved since the merger at the start of 2019. Despite changes in our production profile, for example, with the removal of Long Canyon from our profile, the graph in the top left-hand corner illustrates our strong operating cash flow, and the other graphs on this slide show how we have deployed this across our business. Firstly, as you can see in the top right-hand graph, we have reduced our net debt by almost $4 billion to a level where we have now one of the strongest balance sheets in the industry and can fund our future through multiple commodity price cycles. At the same time, we have continued to invest in our business, not only recapitalizing the underinvestment in our plant and infrastructure, notably in Nevada, but also investing in new growth projects which will maintain and grow our production in years to come, as can be seen in the bottom left-hand graph. And even after this investment in our business, we have generated significant free cash flow, which has allowed us to increase returns to shareholders, as seen in the bottom right-hand graph. I now want to focus on one of our key growth projects, Reko Diq. As part of managing our capital and risk, we have been working with a consortium of Western multilateral lenders to raise up to $3 billion in limited recourse project financing to fund phase 1 of the project. This represents a substantial portion of the overall funding needs and will substantially reduce Barrick's equity funding needs as well as that of our local partners. As can be seen here, our equity contribution is expected to be just over $1.5 billion. The contemplated loan structure is broadly consistent with other large-scale, multi-source mining project financings, with each sponsor responsible for its rateable share of the debt. However, these guarantees will fall away once Reko Diq passes completion tests, at which point the financing will become non-recourse to Barrick. The lender group is primarily comprised of multilateral and agency lenders, most of whom have extensive experience financing mining projects and have previously supported large-scale capital projects in jurisdictions with similar risk profiles, notably the IFC, World Bank, and Asia Development Bank. As you can see, there is a lot of work and and diligence that goes into financing of this nature, and we have been in discussions with the lenders and guarantors for over a year. At this time, we expect to be in a position to be able to draw upon the facility from the second half of 2025. The project already has substantial risk mitigation measures in place through, amongst other things, the protections built into the reconstitution documentation and the alignment through the joint ownership with our local Pakistani partners. In addition, the lender group was purposefully selected to be centered around those agencies that already have significant exposure to Pakistan, including a number of Pakistan's largest sovereign creditors, as I've already touched on. Their involvement in the projects and initiatives across the country helps to further align the interests of the project owners and all local stakeholders, serving as a powerful increment to managing risk. The extensive tenor of the debt, expected to be 12 plus years, also ensures that these risk-sharing benefits will remain with the project for a long time. Thus far, the potential lenders have been extremely supportive of the financing plan and the project and have been reviewing every aspect of the project: technical, environmental, social, security, and economic very closely, which also provides us and our partners with an independent validation of the quality of the project and our approach to developing the operation. Another area that we also focus on, but which often does not receive the same level of attention, is what we refer to internally as our non-operating spend. This is cash flow allocated to corporate costs as well as closure, which, as you can see, we've been working to reduce. This includes our greenfield exploration spending, which we believe creates significant value over the longer term, albeit the benefits are not immediately obvious in our 5-year plans. We aim to maintain our spend at around the same level each year and force our exploration teams to compete for these dollars to ensure they pursue the most prospective options in the portfolio. Some of you may recall me talking about our complicated and inefficient corporate structure, which we inherited at the time of the merger. Since that time, we have simplified the ownership structure of a number of our operating assets and eliminated over 40 legal entities from the group and restructured over $15 billion in intergroup corporate loans. All in all, we expect to reduce non-operating spend to below $600 million going forward. Again, a significant annual saving from where we started. Taking a deeper dive into our G&A, we've been able to significantly reduce this cost since the merger and have maintained this lean structure over the past 5 years. Here, we have benchmarked our G&A cost to our peers, and as you can see, whichever way you measure it, we are the industry leader, which is a testament to our lean management structure. I turn now to our operating cost metrics. You have already had some insight from each of the regions on the evolution of these costs and the underlying cost drivers. So this provides a quick snapshot of how the group cost profile has evolved over the last few years, as well as where we incur these costs. You will note that the percentages of the pie chart are not dissimilar to 2022 when we showed you this slide, although one point to note is that the direct spend on energy has reduced, partly reflecting lower oil prices, but also our significant investment in renewable energy sources. As noted earlier, whilst inflation has been a real factor over this period, a large portion of these increases have been driven by increased spending on our infrastructure through maintenance, as well as increased underground mining costs and grade control drilling, a large portion of which we expect to moderate in future years. As was mentioned earlier, grades and recovery have also impacted the cost per ounce numbers, in addition to the fixed cost dilution, as does the ore feed changing both in terms of underground versus open pit and refractory versus non-refractory, as Christine touched on earlier. You will be familiar with this graph, and this reflects the overall group view, which my colleagues have already explained in relation to their individual businesses. As you can see in the bars, we are growing gold production and delivering a cost reduction over this 5-year period. The benefits of the increasing production is noticeable from 2027 onwards as we spread the fixed costs over more ounces. If you include our gold equivalent ounces, the growth is significant, as you can see in the dotted line. To note, these costs and capital profiles are all in real terms, as has always been our practice. On capital, as Henri explained, we expect the reinvestment phase at NGM will turn the corner in 2025 and return to normal levels by 2027. So that is evident in the group picture too. Every year we add more ounces to our mine plans and add years of life. But with that, we also need to add more capital, some of which you will only see the benefits of beyond this 5-year window. So that explains a lot of the change from prior versions of this graph. Looking at our copper business, this is where the bulk of our growth capital will be focused over the 2025 to 2027 year period as we advance both Lumwana and Reko Diq. And as you heard earlier, the feasibility studies for both these projects are expected to be completed by the end of this year. And now that 2029 is inside our 5-year horizon, the benefits of these investments are clear to see. So we expect to see the value of these significant assets start to reflect in our share price. The fundamentals for copper remain very strong, with a significant supply-demand imbalance forecast over the coming years, just as we start to deliver these projects' outputs into the market. When one considers the lead times and capital for new projects of this size, it's incredible what our team has achieved and is planning to deliver in a relatively short period of time. This graph conveys the outcome of our production and cost profiles in the 5-year plans in terms of cash generation at different price point assumptions. In other words, the cash we expect to generate from the operations in this 5-year period. Although it shows some leverage to copper, it's worth noting that this leverage understates the true value leverage of the copper business, given our ramp-up in production is at the end of the 5-year window. This chart explains why we are investors in buying our own stock back at the current prices that are not representative of this inherent value. To finish, I thought it would be worth recapping the returns we have already provided to shareholders. At the start of 2022, we set out a clear dividend policy that we have consistently followed since this time, unlike some of our peers, and which has contributed to over $5 billion in returns to shareholders. This dividend policy was supplemented by an introduction of a $1 billion share buyback program, which has been renewed on an annual basis and which allows us to increase returns and take advantage of the significant value we see in our shares. We have been active in this program since the second quarter of this year and expect to continue to do so going forward. And with that, I'll hand you back to Mark to wrap up today's presentation.